Think back to the early months of 2009. The primary stock market index had bottomed out at a staggering low of under 700 points. The global financial system was essentially in cardiac arrest. It had been half a year since the massive failure of Lehman Brothers. Families watched in horror as their life savings evaporated overnight, often losing half their value in a matter of weeks. Every news outlet was screaming about a second Great Depression. The collective mood was one of pure, unadulterated dread. Yet, in the middle of this chaos, a librarian named Arthur decided to make a move that looked like a financial suicide mission to anyone watching. He took $60,000 he had painstakingly set aside for his golden years and dumped every cent of it into a standard index fund tracking the largest companies in the country. His coworkers thought he had snapped under the pressure. His siblings pleaded with him to keep that cash under a mattress until the world stopped ending. Arthur tuned out the noise. Fast forward to the present day, and that single $60,000 move has ballooned into nearly $700,000. He didn't have to be a stock market wizard. He didn't need a high-frequency trading desk or a direct line to a senator. He simply recognized a rare historical window, the kind of moment that appears maybe twice in a lifetime. It was a moment where the sheer volume of public fear created a gateway for life-changing wealth. The reality that most people are missing is that we are currently standing on the threshold of a similar phenomenon. This isn't about a sudden market crash, though. It is something far more persistent and arguably more transformative. We are witnessing a collision of economic trends that hasn't been seen in nearly 100 years. It is a shift that is set to migrate more capital into the hands of the general public than any other era in our history. The figure we are talking about is $124 trillion. That is not a clerical error. Over the next 20 years, that mountain of wealth is going to change hands. Most individuals are completely oblivious to the fact that this is happening, let alone how they can align themselves to catch the overflow. Today, I want to break down the mechanics of this shift. I want to show you why the current landscape looks almost exactly like the greatest wealth-building periods of the past, and explain the precise tactics that smart investors are using to ensure they are on the winning side of this historical handoff. The story of what followed that 2009 valley is a perfect blueprint for how normal people achieve extraordinary financial status. The market did not just crawl back to where it was. It ignited into a massive, multi-decade expansion. From that low point in 2009 all the way through the beginning of 2026, the equity markets surged by more than 900%. We recently saw the benchmark cross the 7,000-point mark for the first time in history. A simple $100 bill put to work at the bottom of that crisis would be worth $1,000 today. But here's the kicker. The people who walked away with the biggest gains weren't the guys in expensive suits on Wall Street. They were the nurses, the shop owners, and the office managers who just kept their heads down and continued funding their retirement plans while everyone else was busy panic selling. The statistics are mind-blowing. In 2010, there were roughly 8.5 million millionaire households in the United States. By the time 2024 wrapped up, that number had surged to nearly 24 million. We added 15 million new millionaires in just 14 years. To put that in perspective, that is like the entire population of a major global city becoming millionaires in a little over a decade. Where did all this new wealth come from? It didn't come from a wave of high-tech startups or lottery wins. The vast majority of these people were just average citizens who participated in the broad growth of the economy through basic investment vehicles. A major wealth report from 2025 pointed out that the U.S. was minting over 1,000 new millionaires every single day in 2024. Most of them didn't hit a jackpot. They just benefited from the relentless upward march of asset prices. Experts now refer to this group as the everyday millionaire class, people with a net worth between $1 and $5 million. Globally, this segment has grown fourfold since the turn of the century, now totaling over 50 million people who control tens of trillions in capital. The road to joining this group isn't a guarded secret. It is a well-traveled path that is about to become even wider. What makes right now even more compelling than the 2009 era is a phenomenon known as the Great Wealth Transfer. Research from leading financial firms indicates that about $124 trillion in various assets will be passed down between now and 2048. This is the single largest movement of wealth in the history of our species. Nothing we have on record even comes close to this scale. To grasp that number, you have to realize that $124 trillion is more than the total economic output of every single nation on the planet combined. It is 5 times larger than the entire national debt. This is 8 decades of American economic growth finally starting to trickle down through the family tree. The math of this is simple, but the impact is massive. The baby boomer generation, born between the mid-40s and the mid-60s, currently holds about 52% of all the wealth in the country. We are talking about $78 trillion sitting with one specific age group. The youngest members of that group are hitting their early 60s now, while the oldest are entering their 80s. Over the coming 2 decades, that capital will flow to their heirs, their grandchildren, and various philanthropic causes. It is estimated that $16 trillion will go directly to children and another $18 trillion will be donated to charity. Generation X is looking at an inheritance of roughly $39 trillion over the next quarter century. Millennials are set to receive an even larger chunk, somewhere in the neighborhood of $46 trillion. Even the youngest generation, Gen Z, will start seeing the effects of this as the process picks up speed in the 2030s. The timing of this is a game changer. Gen X, which is often overlooked, is going to see an influx of about $1.4 trillion every single year for the next decade. This is happening right as they are squeezed between supporting their kids and looking after their parents. For them, this wave could be the difference between a stressed retirement and total financial freedom. Millennials have a longer wait, but the payout is even bigger. By the time that $46 trillion arrives, many will be in their highest earning years, meaning they can use that inherited capital as a massive force multiplier for their own savings. But the part that everyone misses is that this isn't just about who gets a check from their parents. It is about the secondary effects that this much money moving around has on the entire world. When that much capital is in motion, it doesn't just sit in a bank. It gets reinvested. It gets used to buy property. It gets poured into new business ventures and technologies. Every single dollar that moves creates a chance for someone else to step in and capture a piece of the action. The last time we saw a shift of this magnitude was in the immediate aftermath of the Second World War. When the veterans returned home, the implementation of the GI Bill sparked a massive wave of home ownership and entrepreneurship, essentially constructing the modern middle class that fueled half a century of American dominance. That specific era of growth is what produced the very baby boomers who are now preparing to pass their fortunes down. We are watching a historical cycle repeat itself, but the volume of capital involved this time makes the post-war boom look like a drop in the bucket. The connections between the current landscape and the 2009 era are far more profound than the average observer realizes. Back in 2009, 3 specific stars aligned to create a wealth-building perfect storm. First, assets were being traded at a massive discount because the market had just dropped nearly 60%. Second, there was a tidal wave of capital being injected into the system via government intervention. Third, the general public was either too frightened or too broke to do anything about it. Today, we are seeing a similar alignment, even if the mechanics look a little different. While we aren't currently sitting at the bottom of a stock market crash, the sheer velocity of the wealth transfer is going to create massive pockets of opportunity. Think about it this way. As trillions of dollars move through estates, some assets will have to be liquidated to settle taxes or distribute funds among siblings. Other chunks of capital will be moved into entirely new types of investments by heirs who have different goals than their parents. This constant motion creates entry points for anyone who is prepared to act. And while the government isn't the one printing the money this time, the private sector is effectively doing the same thing as the wealthiest generation in history starts to hand over the keys. The scale of this move, $124 trillion, dwarfs any government stimulus package ever conceived. For a bit of context, the total amount spent on global pandemic relief was around $5 trillion. This wealth transfer is 25 times that amount, and it will be flowing through the economy for the next 2 decades. Just like in 2009, the vast majority of people are looking the other way. The media is obsessed with daily fluctuations in interest rates or the latest political drama, giving almost zero attention to the slow-motion earthquake that is the Great Wealth Transfer. The people who hit millionaire status after the 2009 crash weren't necessarily more intelligent than their neighbors. They were just positioned correctly when the wave hit. The same rule applies right now. To capture this opportunity, you have to understand a few critical realities. The first is that simply waiting for an inheritance check is a losing strategy for most people. While the headline numbers are astronomical, the wealth is highly concentrated. Research shows that about 62% of this money is held by the top 2% of households. This means that a relatively small number of families are going to inherit the lion's share of the cash. Most families will receive much smaller amounts or nothing at all. Therefore, the real play isn't the inheritance itself. It is the economic climate that this massive movement of money creates. It is about what happens to the value of assets when trillions of dollars are looking for a new home. Consider the domino effect. When huge sums of money are moved into brokerage accounts, it drives up the price of stocks, which benefits anyone who is already in the market. When heirs decide to use their new wealth to buy real estate, property values in those areas start to climb, rewarding existing homeowners. When that capital is used to start new businesses or expand old ones, it creates jobs and fuels innovation across the board. This transfer acts as a rising tide that lifts every boat in the harbor, provided your boat is actually in the water. Second, you have to look at where the money is actually going. There is a massive generational divide in how people view money. Data from major investment banks suggests that younger investors, those between their early 20s and mid-40s, have a completely different philosophy than their parents. Over 70% of this younger group believes that the old-school strategy of just holding a mix of traditional stocks and bonds is no longer enough to get ahead. This shift in mindset is going to redirect trillions of dollars into new sectors. While the previous generation loved blue-chip companies and government debt, the heirs are much more interested in alternative assets, direct equity in private companies, and emerging technologies. We are already seeing this play out in the middle of 2026. Massive amounts of capital are being poured into the infrastructure for artificial intelligence, driving the valuations of companies in that space to unprecedented heights. Other sectors like green energy, medical technology, and digital finance are positioned to capture a disproportionate amount of this incoming wealth. This doesn't mean you should throw away a diversified portfolio, but it does mean you need to be aware that the places where capital used to congregate are changing. Third, the real estate market is going to be completely reshaped by this process. The way people buy and sell homes over the next 20 years will be dictated by the geography of the wealth transfer. On one hand, you'll see an increase in demand as heirs use their windfalls to upgrade their living situations. On the other, you'll see a surge in supply as inherited family homes are put on the market. But this won't happen evenly. Suburban areas and traditional retirement communities might see a flood of inventory as the boomer generation passes on. Meanwhile, the cities and tech hubs where younger generations want to live could see prices skyrocket as newly wealthy buyers compete for limited space. We can already see this divergence in the numbers. Since the start of the millennium, home prices have climbed over 150% on average, but that growth has been incredibly lopsided. A house in a stagnant market might have barely kept up with inflation, while a home in a high-growth tech corridor has quadrupled in value. Understanding the map of where wealth is moving is just as important as understanding the math of the investments themselves. Fourth, the most effective tool in your arsenal remains the simplest one, staying the course. Look back at the example of Arthur, who put $60,000 into the market when the world seemed to be falling apart. He didn't need a complex algorithm. He just needed the capital to get started and the mental toughness to stay invested when things got bumpy. Over long stretches of time, the market has historically returned about 10% annually. If you had started putting away just $500 a month into a basic index fund back in 2009, you would be sitting on over $250,000 by now. And that is without any fancy tricks or lucky breaks. But that path was not a straight line. Think of all the reasons people had to quit over the last 15 years. There was the European debt crisis, the political standoffs over the budget, the trade conflicts, a global pandemic, and a brutal market correction in 2022. Every single one of those events was accompanied by headlines telling you that the party was over and it was time to run for cover. The people who listened to those warnings and pulled their money out missed the massive recoveries that followed. The wealth transfer is going to provide a massive tailwind to the economy, but the only way to catch that wind is to keep your sails up, regardless of the weather. The interesting thing about these golden ages of wealth creation is that they never feel like golden ages while you are living through them. The years following 2009 were filled with anxiety. There was a constant stream of experts predicting the next collapse. Yet, the market just kept grinding higher. It crossed 2,000, then 3,000, then 5,000, and now we are looking at it sitting above 7,000. The people who made life-changing money were the ones who could sit through the discomfort. Research from firms like Goldman Sachs shows that if you missed just the 10 best days of the market since 2009, your total returns would have dropped from 17% a year to just 12%. If you missed the 25 best days, your gains would have been cut in half. And here is the catch. Those best days almost always happen right in the middle of a crisis when everyone is terrified. The same pattern of fear followed by missed opportunity will likely define the era of the great wealth transfer. We will undoubtedly face future recessions, market corrections, and global crises. There will be moments when it feels like the old rules of economics have been thrown out the window. However, the fundamental reality remains. There is a $124 trillion engine of capital looking for a place to go. Short-term volatility is just noise compared to that level of industrial strength momentum. Let's look at some concrete numbers to see what consistent participation actually looks like during this transfer period. Imagine a person in their mid-30s today who decides to commit $1,000 every month to a diversified portfolio for the next 25 years, the approximate timeline of this wealth migration. If the market continues to return its historical average of 10%, that individual would end up with roughly $1.33 million. Even if we use a more conservative estimate of 7%, they are still looking at nearly $800,000. But here is where the wealth transfer factor comes in. If the massive deployment of this inherited capital boosts economic productivity by even a single percentage point, those outcomes shift dramatically. A small bump in annual returns can translate into hundreds of thousands of extra dollars over a career. Beyond just personal investing, we need to talk about the industries that are going to explode as this money moves. When that much wealth changes hands, it creates a massive demand for professional services. We are going to see a huge expansion in financial planning, estate law, tax strategy, and wealth management. Real estate transactions will move at a faster clip. Even the legal sector will see a surge in demand as families navigate the complexities of large estates. People who position themselves in these careers or start businesses that serve these needs will find themselves in the middle of a decades-long bull market for their skills. The data is already reflecting this. The percentage of younger clients at major wealth management firms has more than tripled in the last few years. The advisors who actually understand the goals and values of Millennials and Gen Z are currently winning a race for capital that will compound for the next 40 years. There is also a significant spousal transfer phase that people often ignore. Before money moves to the children, it often moves to a surviving spouse. In fact, over $50 trillion is expected to pass to surviving partners first, much of it going to women who tend to outlive their husbands. This is creating a massive and underserved market for financial services tailored specifically to women, who will soon control more wealth than at any other point in history. This transition isn't a single event that happens on a Tuesday. It's a marathon that is already well underway. The oldest boomers are approaching 80 years old. The transfers are happening as we speak. If you are waiting for the perfect moment to get into position, you are effectively watching a train leave the station while you're still checking the schedule. The best time to start building your foundation was years ago, but the second best time is the very moment you finish listening to this. What stands out most when comparing 2009 to today is that all the information was, and still is, completely public. There was no secret memo in 2009 telling people the market had reached its low. It was right there on every news ticker in the world. Similarly, the facts about the $124 trillion transfer aren't hidden in a vault. They are in research papers, demographic reports, and government data. Yet, most people will still fail to act. In 2009, they were paralyzed by the fear of the present. Today, they are paralyzed by the distractions of the immediate. The people who will look back on this era as their millionaire maker moment are simply those willing to look at the long-term data and act on it, while everyone else is looking at their phones. A practical framework for this would look like this. First, maximize every tax-advantaged account you can get your hands on, whether it's a 401k, an IRA, or a health savings account. These are the buckets that will catch the overflow of the wealth transfer without losing a chunk to the tax man every year. Second, keep your exposure broad. Don't try to gamble on which specific stock will win. Own the whole economy. As that 124 trillion flows into the system, it will lift the entire market. Third, look for ways to gain expertise in the areas where money is moving. Whether that's through your career or a side venture, being near money in motion is always profitable. Finally, extend your horizon. If you think in terms of months, you will get shaken out by the first headline that scares you. If you think in terms of the 25-year wealth transfer cycle, you become almost immune to the daily noise. The school teacher who invested in 2009 didn't have a crystal ball. She just had a long-term view and the courage to act on it. The opportunity sitting in front of us today is different in its details, but identical in its potential. History is currently writing a chapter about the greatest migration of wealth ever seen. You have the data, you have the timeline, and you have the strategy. The only question left is whether you will be a participant in this expansion or just a spectator watching from the sidelines.